What's up, everybody? It's time for another edition of the chart book. It's been so long. It's early August. I think last time I did one of these was in February, March. It's good to be back. I'll commit to doing these once a month. If you guys can promise to get to 10, 20,000 views on YouTube, leave a review, leave a comment. Love to hear the feedback. You got any questions? You can see today I'm wearing my extra special Christmas gift, which is a Faber College shirt. Anyway, anyone seen Animal House? They know my relative Emil, his famous words, knowledge is good. So we're going to try to drop some knowledge today. Can anybody see the bear grumbling in the background of my Zoom? This is a famous Bev Doolittle painting I like to use in the background. It's an analogy for where markets are right now. We'll get into that a little bit. But guess what today was? This week was Robinhood's IPO. You guys have probably found me dragged out of bed early on the West Coast for CNBC to talk all about Robinhood. And it usually sounds like a hater. I promise I'm not. But if you saw me today, today was the day their stock was going kind of bananas. By the time this comes out, who knows? It could be anywhere between 10 and 500, given what the meme stock's been up to. But we put a poll on Twitter recently, and we said, with Robinhood going full meme stock, will this be the final confetti cannon to mark the peak of this bull market, or will it just be one more step along the way in this bull market? And 70% said there's lots more to go. So historically, we like to tell people this: all-time highs are nothing bearish in and of themselves. There's lots of other yellow flashing lights, but the trend is still up. We talked about a little bit about Robinhood, where we said, first of all, congrats to all the VCs, the founders, the investors. It's been an absolute decacorn outcome. Way to go, guys. I'm still critical that it's a business that's good for the end investor. I think, however, the outcome over the next 10 years, they could easily grow to be a $100 billion company. They could also be a gravestone. And I think there's some simple things that company could do to become this $100 billion, $200 billion plus company. So on the good side, if you were to list the positive things they've done, number one, they've onboarded tens of millions of new people to the financial markets. That's incredible. Awesome. They've done so, and they pushed the industry forward with low cost commissions to zero commissions. Amazing. The problem is they then led them to the casino. And the laundry list of negatives of this company is so long, I couldn't even list most of them. So the question is, will they be the first to decide, hey, look, let's grow up, we'll put our customers first, or will they continue to churn them? And I said they could implement 4 things overnight that will really help them graduate into almost like a Vanguard 2.0, which I'm cheering for. I would love to see. I don't think that'll happen. As Upton Sinclair famously said, it's difficult to get a man to understand something when his salary depends on him not understanding it. And so all the incentives for Robinhood are to get you to trade options as much as possible, to get you to trade these crappy coins as much as possible, because that's where they get their revenue. But theoretically, let's say they wanted to become the next Vanguard 2.0. Number one, they have to stop lying, or at least stop being dishonest and tell the truth. There's been so many times these guys have just outright not been forthright or told, in my opinion, bold-faced lies. For example, let's ignore the whole GameStop fiasco. Do you remember when they claimed you could get magical 3% risk-free yields on your cash until the government was like, whoa, you can't claim that. That's illegal. Do you remember when they've come on lots of media outlets recently and said, oh, by the way, most of our investors are buy and hold investors, despite the fact they trade 80 times more than the average Schwab investor? There's just no chance that's possibly true. Why do you feel the need to even claim that? Like, you don't need to fudge things. So just be honest and transparent is a great first step. Second, you need 100x, maybe 1,000x customer support. One of the biggest complaints in the recent fine, $70 million, meaningless to Robinhood. Again, they're a $50 billion plus company doing billions in revenue, was they didn't even disclose their customer complaints. You have to disclose your customer complaints to the regulatory bodies, and they had tens of thousands of customer complaints. And that's just bad business. So not reporting that, but also their customer service is so bad. This is very serious. This sort of move fast and break things attitude that exists in Silicon Valley and software. That's okay if you're doing like a ride sharing app that is delivering you tacos. It's not okay if you're dealing with people's livelihood. And in this case, if you guys remember back to the young investor who was mistakenly shown a minus $700,000 balance, tried to get in touch with them, email, call, no answer, ended up committing suicide. So these types of things where you make a mistake in the software world, in the financial world, it has real repercussions. So you have to take that seriously. Number three, they've been well covered in the media for the payment for order flow and securities lending. And, I actually have a different take than most on this. I don't think anyone really cares that they do payment for order flow, meaning they sell your orders to Citadel and hedge funds. I don't care that they lend out your securities to the hedge funds so they can short your stocks in your portfolio. What I do think people care about is you keep all the money. So Robinhood could implement something where they say, you know what, we're going to give half of the payment for order flow, half the securities lending revenue back to the end customer. That's never going to happen, of course. Lots of funds, our fund complex, most funds, ETFs, they do securities lending, but guess what? They give it all back. And this can be material. It can be tens of basis points. It can be entire percentage points. There's funds out there that you see that have 1, 2, 3 percentage points in yield or revenue they give back to the end customer, whereas some places keep it, like Robinhood. So I don't think people are upset that you're doing it. I think they're upset that you're keeping all of it. Lastly, and this is the big cultural one, you have a decision to be Vanguard 2.0 or the Win or Caesars 2.0. And very much the app today is a casino. At every possible juncture, you get to a fork in the road, the incentive is to get you to trade more and more garbage sort of securities. So crappy coins, options is their biggest revenue item. 22 million investors, half of which are first timers. You should not be introducing them to hyperactively day trade options. That's crazy. The best analogy I can give is there used to be a bunch of Forex brokerages that were publicly traded, and they had to disclose what percentage of their customers made money, or said differently, what percentage lost money. You know what percentage lost money? 98%. Absolutely insane. But when you eventually churn your customers, you have no customers. So they have to develop this sort of behavioral path to where eventually you lead them to the right place and make the right decisions. Not, hey, I'm going to opt you into a margin account here, go trade some options. No, we want to discourage you from making tax inefficient trades. We want to discourage you from hyperactive day trading. We want to push you into decisions that help nudge you in the right direction. Again, look, I don't think this will ever happen. You would have to hire probably an outside company or consultancy or people to come in and help overwrite this culture. Again, I don't think it'll ever happen. Look, I'm cheering for them. I think they could certainly be the next Vanguard 2.0. The question is, do they want to be? And I think the answer is no. Let's hop over. I'm going to do a screen share. A lot of these charts come from the Idea Farm, which you guys don't know is our research service. It's ideafarm.com. We send out the top 2 or 3 most curated investment research pieces each week. We send out the top podcasts. We send out quarterly the top valuation metrics of all the global stock markets. We send out an asset allocation backtester. Anyway, it's a pretty fun site, and it's got over 500 pieces in the archives. It's like getting a master's in investing if you wanted to spend some time there. Check it out, free 30-day trial. Well, what do we want to talk about? First stop, here we are in the summer of 2021, expectations. This is a survey, just came out from Natixis. This certainly is going to trigger a lot of people. And you can see in this long blue chart over here, I'm getting used to it, sorry. The expectations for investors around the world for stock markets. And look who comes in. Number 1, USA with the most unrealistic expectations of 17% per year. Not only that, this survey is real returns, which means that's before inflation, which is even crazier. So we're talking 20% returns per year, which is essentially almost never happened in the history of markets. Financial professionals tend to be a bit more sober. Looks like down around 5% across the board. In the US, again, they're higher, 6.7%. Pension funds, state and local governments, not quite as crazy, and these are nominal returns, but historically we've sort of decried state and local governments expecting 8% returns. And then the S&P 500 companies are a little more sober still. They're down around 6.5 as interest rates have come down. But here's the problem. Let's talk about stocks first. Here's the S&P 500 dividend yield. It's plumbing all-time lows. The low hit in 2000, I think, was 1.1%. We're at 1.3%. This is one way of looking at value. Another way, of course, is the Shiller Cape ratio. There's a million of these. Doesn't matter which one you use. They always say the same thing at extremes. We're the second highest valuation ever, next to the late 1990s internet bubble, which hit 44. So we're about around 15% away. I actually did a podcast with Professor Shiller, and I said, I think we break out. I think we pass 1999. We'll see if it happens with this sugar rush of reopening. But either way, it's high. Well, what does that matter? Oh, by the way, if you look at all the other metrics, here's a few from Luthold Group. These show a different metric: price to peak cash flow, earnings. Doesn't matter. Many cases, the valuation metrics are actually higher than the all-time high. Cape ratio is actually one of the more subdued. It's only second highest ever. And historically, if you look at the components of return in markets, you have dividends, which are sort of the steady eddy ballast. Look over the years, it's sort of ranged 1.8 to 4% per year. And then you have the big capital appreciation, which is the growth as well as the valuation component. And the 2000s, darn right stinky. You had multiple contraction and only a little bit of dividends. Well, the dividends are even lower now, again, 1.3. So what can you do? You can plug this into a model to get expectations. Do we expect 20% returns? What everyone expects. And so this is Bogle, before he passed, wrote about this in the 90s and updated again a handful of years ago. He said, look, to get to the roughly 10% historical stock return in the US, you give three components. First one is dividend yield, and that's roughly the dividend yield over the past 120 years, 4.8%. Gone are those days, my goodness. 4.9% on the earnings or dividend growth. And the nerds out there can decompose that into two parts: inflation and real earnings or dividend growth. So inflation right now picking up, but we'll assume historical earnings growth right around 5%. And historically over time, you've had a little bump from markets going up over the past 120 years. So that's the valuation component of 0.3% as multiples have gone up. So you can plug these in because you know what dividend yields start. You know what the Cape ratio start is. Currently it's at 38. We can say, look, let's go forward 10 years, 2021. Where's Cape ratio end? We can look at the most probable scenarios. So it going back to average over time, which is 17, but more realistically, the average of the last 40 years, or the average when there's low inflation, which we still currently have, which is 21. Well, you end up with 10-year real nominal returns of 0. So donut, nothing, which isn't great. Now, if it sailed back through, and probably that wouldn't happen unless inflation takes off. So when you're in that sort of 1 to 4% inflation safe zone, people pay higher multiples. It's really when you get above that or below when multiples crater. People aren't willing to pay 20, 25, 30 and above multiples on stocks when inflation ticks up at 5, 6, 7%. Not saying that's going to happen, but if it did, you could have multiples go back down to level of 10, or is the lowest they've ever been in the US is 5. And look at that. That's really nasty. -5, 10% per year returns for a decade. Just to stay flat, if valuations stay where they are for the next decade, you only get 6%. Okay. Remember, expectations are a lot more than that. And then if they go the highest level ever, you only get 8%. Again, what's the problem with all this? Why does this even matter? Let's say you get 6, 8%. Well, the good news is, come on, Lloyd, the GIF's not working with this new Zoom share. But what he wants to say is, you're saying there's a chance. But if you look back in history, this is unrelated to Cape ratio, but you say, what were the 3 best starting points for US stocks? What were the 3 worst? What were the initial conditions? What were the ending conditions? And look at that. There's that 20% return people were expecting. And then, of course, on the flip side is 0. And you look at the initial conditions. Well, when times were good, the starting point, dividend yield was super fat, 5%, valuation super low, 11. And they expanded over the course of the decade. So ended at 25. On the flip side, what were the bad conditions? You had a lower dividend yield, much higher valuation, and then valuations went down. If you plug in where we are now, it's actually worse than the worst starting points, right? You have a worse dividend yield, a higher valuation. So you really need everything to be just right to end up with decent stock returns for the next decade. I did a couple tweets on Twitter talking about this. I said US stock valuations are the second highest ever. I actually tweeted this when they're at 34, now they're at 38. But I said, here's the interesting point about markets and why they're so hard. The first time they ever hit 34 was in 1998. Guess what happened next? The market went up another 50%, not 5%, 50%. But then the problem after that, no returns for a decade afterwards. How do people deal with that? That's tough. And then as you get up to above 35, 38, we did a different study and said the major indices haven't closed above 38 that many times. I think it says 35 here. Future 10-year returns on average were zero. So it happened to the US in the late 90s. It happened to IFA in the late 80s, particularly because of Japan, again in 99. Emerging markets, it happened in 2007. Everybody remember the BRICS went crazy. We reran this study with individual countries. We had about 50 country years. The same takeaway. Across 50 years, the average future return was zero. Now, about a third were positive. So you still had positive returns some of the time, but on average, not a great starting valuation. What are some of the weird exhaust of this? If you look at, this is stocks as a percentage of household assets. You can see that people had a lot of stock in the nifty 50s, right? Got up to almost 40%. Then they cratered to what was the biggest buying opportunity of our lifetime. Only 10% of assets in early 80s. And then a 2-year massive bull market. They peaked at 45%, down to 20% in the financial crisis. And look at this, the highest level ever currently at one of the highest valuations ever. And why is that weird? I didn't label this because I posted on Twitter for people to try to guess. The blue line is valuation, so CAPE ratio, and you can see it peaking in the late 90s, going down, going back up, going back down, like financial crisis, then right back up to 38. The red line is AAI's percent allocation to stocks. And so you would expect in general for the allocation to go up as prices go up, to go down as prices go down, because people are simply buying and holding. But the mental problem with this is it's the exact opposite of what you want to be doing. Theoretically, you should want to allocate more when prices are lower, valuations are lower, and allocate less when valuations are higher, particularly at some of the highest levels they've ever been. This chart should be the opposite, but what we often say is valuations and sentiment are linked at the hip. The highest expectations for bullishness the AAI survey ever had was in December of 1999, the highest valuation ever and one of the worst starting points in history. So usually people are most bullish in the exact worst time. Fast forward to 2009 and they were most bearish. So you want to usually be fading the crowd at extremes. And part of that has to do with the market cap weighting. Look, the US is the biggest stock market in the world. It's darn near approaching 60%, which is one of the highest in history it's ever been. But market cap weighting, and again, so many people don't get this right. Listeners, if you're to say, what do you think market cap weighting is? If you invest in the biggest stocks in the stock market, by what metrics? Well, most people don't know. It's actually totally unrelated to value or earnings or anything else. What it's related to is simply price. So as the price of the stock goes up times the shares outstanding, aka market cap, you own more and more. Now, it's a good investing methodology because you're guaranteed to own the winners and you're guaranteed to own less of the losers. The problem is it has no tether to value. So almost any investing strategy other than market cap, you break that link, you'll add 1 or 2% per year. It could be equal weight. It could be weighting by valuation. It could be momentum factor. It doesn't even matter. Letters of the alphabet should outperform. This is a chart from Ned Davis. The blue line is the S&P, and the multicolor line is what if you invest in the largest stock in the stock market at the time it was the largest stock. So look at this laundry list of famous names: Walmart, Microsoft, Exxon, Apple, Amazon. Who's the biggest now? Apple. Historically, it's been a horrific idea. You underperform the market by about 3 percentage points per year. And again, that's just creative destruction. A lot of these companies, by the time they get to be the biggest, they get expensive. That happens within every sector. It happens within every industry in every country around the world. So avoiding the big expensive stocks over time can be a big additive. Bad news is bonds. Back in 99, when stocks were expensive, there were a lot of alternatives. And now we find ourselves in the TINA world. There is no alternative because people tend to only think in terms of US stocks and bonds. And here we are. This is 10-year yields. I think they've now come down to 1.3 again. Real yields after inflation, one of the worst periods in history. The other was the 70s. This is a environment people like to describe as financial repression. Not a good time to be owning bonds. You're almost guaranteeing yourself negative returns unless they go hard negative. And this creates the problem for everyone, which is what you can see is that this is a chart from JP Morgan that shows income generating from a standard savings account with money market or commercial paper yields. And the blue line is income needed to beat inflation. And for a long time, you could just park your money and get a reasonable income. That hasn't been the case for about a decade. You can't really find traditional income, which is why a lot of people have moved out the risk curve into other investments and pushed them up in valuations, be it equities or REITs. And so this has a setup of one of the worst opportunity sets for a traditional 60-40 portfolio. The yield is super low. If you look at the earnings coupon and subsequent returns, it's off the charts as to how bad it looks relative to history. I think this is well known. The problem is most people don't really do anything about it. So what can you do? One thing you can do is say, look, lower your expectations. Say, I'm going to straight up assume I'm going to get less than 5% returns on my stock and bond portfolio. I'm going to save more, spend less. We got Homer over here and the bartender saying, just take your medicine, you lush. But that's no fun. Nobody wants to hear that. It's really Debbie Downer depressing. So let's think about some things we can do. One, this is a tweet where one of the greatest allocators of all time, if not the GOAT, Yale's David Swinson, was a big proponent of thinking different. He was often early to asset classes and strategies, and just a good example of how different he thinks. This is Yale's US stock exposure over time. 1980s, they had a very traditional allocation, 60% in US stocks. By 95, he'd cut that by 2/3. 2005, down to 14%. Today, it's 2%. Now, to be clear, they have other investments that have what would be considered traditional equity beta. So venture capital, private equity, hedge funds that have a long bias or even long short with a long bias. That'll look like US stocks. But the point is, he's not allocating to the S&P 500 through a low-cost index fund. He's doing something quite different. And historically, this has generated a huge amount of alpha for a pretty large portfolio. But the point is, how many of us out there have a 2% weighting to US stocks? Well, no one does, right? Most people want something warm and fuzzier that doesn't have as much career risk or emotional risk attached to it, and thinking differently and for yourself. So where are we right now in 2021? Look, we have this scenario where there's a lot of opportunities. It's a different opportunity set than 99. You can't just hide out in bonds, but there are some similarities. I think you can hide out in value. So this is the traditional, this is a chart from Prospect via FactSet UBS that shows valuation gap between growth and value, one of the biggest they've ever been since the 2000s. Here's another chart from S&P. Again, you have this huge dispersion, expensive to cheap over time, despite the fact everything's gone up. The really expensive has gone up even more. And value's kind of been nothing to speak of over the past decade. This is a chart going back to 80s that shows value ensemble and how it's done. So it's gone up. There's been some periods of sideways, but for the most part, gone up and over the right and added outperformance. But really, since the financial crisis, it's been flat. And then it had kind of nosedive going into COVID. And then you have this massive run up. And I say that jokingly because you see this little blip right on the right side. And that's the quote, massive run up that value is seen, but you're still at a huge spread relative to traditional expensive names. And here's a spread from the same group that shows, according to their metrics, it was even higher spread versus 2000 between value and the market. This is my nomination for chart of the year. The data is from French Fama, which is free, but it's sourced via Robeco. Can never get this pronounced right. This guy's from the Netherlands, I think. Had a few of those fellows on the podcast. They do great work. They did this chart. They said, let's go back to the 1920s. And we're going to look at the value factor, high minus low performance over the course of the year. And it's all these gray lines. You can see the various paths it's taken. And the worst year for value ever was in 1999. And guess what the best year ever was? 2000. Everyone, that makes sense in retrospect, until 2020. 2020 was worse for the value factor than 1999. Let that sink in. That's insane. The worst year in history in over 100 years. But guess what? 2021 is playing along to the script of 2000. It's actually doing quite a bit better through the first half of the year. You actually didn't have the big move in 2000 until the second half of the year. So I think the value trade is just starting within the US. I think it has a long way to run. And when I say long way to run, I don't mean 10 or 20 percentage points. I mean hundreds of percentage points over the course of 5 to 10 years. But it's not just a US phenomenon. Again, as the US market cap growth, expensive names get more expensive, the US gets bigger as a percentage of world market cap. It's now 60%. And again, if you're a global indexer, that means you put 60% in these, we consider it the second most expensive market in the world out of 45 countries. So you're overweight all the expensive stuff. And that's crazy. Why would you ever do that? Most Americans have 80% in US stocks, which is even crazier, particularly if you're doing market cap weight. I think if you tilt towards value, you're going to be okay. But market cap weight, I think you could be in for a really rude awakening over the last 10 years. Everyone seems to extrapolate this recent 10-year performance of the US. But I think this mountain range is instructive because historically, US versus foreign is a coin flip. It's 50-50 in any given year. What's going to happen? You can see times when foreign outperforms by a lot. You can see times when the US outperforms, and it kind of goes through its various regimes and cycles. Hard to predict when it's going to happen. But if you look at the valuations at the start and beginning end of these periods, it becomes a lot easier to use as a guide. And so, again, this is another one from MSCI that shows the US in history as a percentage of market cap, and it's the highest it's been all the way back to 1960s, where it was a bigger percentage. You got to remember, in the 60s, there weren't as many countries in the world around. So to say that the US is one of the biggest now, as emerging markets have developed, as you have China and India and all these other countries, is saying a lot. You have one of the biggest valuation spreads in 40 years, US versus foreign. We did a chart on this on the blog, and we have a whole series called The Case for Global Investing. If you haven't read it, check it out. But it goes to show, this is JP. I like using other people's charts because it doesn't feel as biased as just using all of our own. But here's JP Morgan showing the value spread between the US and international. Same thing with dividends. By the way, you can get a 3 to 4% dividend yield in foreign markets, particularly with a value tilt. Again, the US is 1.3. That is a massive difference, and it correlates highly with value in those markets. We like to talk about valuations. We published this quarterly idea farm, US at 38, average country and foreign developed 24, so reasonable, not great, but not terrible. Foreign emerging, downright cheap, and the cheapest of the cheap is down at 12. If you can recognize some of these flags, you can see which of some of the cheapest countries, like Poland, like Czech Republic, like Russia. And there, you get so much pushback. I mean, we've been through this so much over the years about people, all the reasons why the US is special. And again, I think it is special. It's an amazing place. But they say, well, Mab, the US should have higher valuations, in which case I ask, what was the valuation premium over the past 40 years? And people come up with a number, and the answer is actually zero. There's been no valuation premium. They both trade about the same levels. They tend to oscillate and go back and forth, as you can see in this chart. EFO was much higher in the 80s, largely due to Japan. For much of the rest of the period, they traded in line until 2009 to now. You got this big alligator jaw opening where you have this giant spread. This is the AQR piece that said, by the way, almost all of the outperformance of US over the rest of the world over the past 40 years has been to multiple expansion, meaning the US simply getting more expensive. Not any other magical earnings or anything else. It's simply the valuation metrics have gone up. There's other opportunities. GMO, Japan, small caps trading at a pretty big discount. Here's the challenge. Other than business risk, career risk, looking different risk, going back to the Swinson part, like you have to look different if you're going to outperform. Otherwise, just buy the global market index and be done with it. This is an old Vanguard study. Now, they're framing this as active versus passive, but it really applies to anything, asset classes over the long period. And they showed all funds active. This was 2000, 2014. Only half survived. By the way, your average mutual fund over 10 years, about half disappear, which is incredible, right? So there's like half of them are going to be gone. Only a quarter survived and outperformed. So pretty bad odds, right? But even the successful funds had massively long periods of underperformance. Almost 98% underperformed at least 4 years. Fewer funds were able to do it without 3 consecutive years of underperformance, and only 10% didn't have 3 consecutive years of underperformance. Anyway, take a look at this paper. You can dive into the data. The point is, most people optimize their decision making on, now it's like months and quarters, but historically it's been 1 to 2 to 3 years. If something underperforming, it's gone. They chase the hot manager. Bogle wrote about this. We've written about it over the past 50 years. If you look at the top 20 funds per decade, they underperform the next decade because all the hot money comes in, things get more expensive, things change. Okay. And you could go through this on so many cycles. And so everyone's chasing the hot money now, the hot managers. We've had a return of the all-star manager. Consider in your allocation, having a plan, of course, having a policy portfolio with targets, but also trying to tilt away from the things that are working to the things that aren't working. We've talked about it with Arnott and Howard Marks on the podcast, talking about over calibrating or over rebalancing to a specific target. And rebalancing takes care of that, but you could even move even further. But the point of this is even the successful ones underperform, whether it's an asset class or a strategy. And here's some more charts. Summary, chart book. This is a quick one. Hopefully we'll do this monthly. If you guys like it, send us some feedback at themebfabershow.com, or here's my email and Twitter. Hit us up in the comments on YouTube. Let us know what you think about the new format. Kind of weird. Me is like a ghost down here. But quick summary. US market cap weighted stocks and bonds don't look that awesome. Very technical term description. There's other things you can do. You can consider tilting away from market cap towards value. Within the US, you could do value internationally. Those are 2 of the biggest spreads we've ever seen. There's a lot of other strategies we didn't cover today, like trend following or tail risk. We can do in future chart books if you guys want. You got to be mindful, by the way, always, 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 of all the expenses, all the costs, all the taxes. Those all have a huge impact over time. And of course, give it time. When you make some of these allocations, particularly ones that look different, try to measure it in terms of years or even decades rather than days and weeks. All right, guys, this has been a lot of fun. Send us feedback. We love hearing from you guys. Thanks for listening, friends, and good investing.